Good afternoon. I'm Antoine, the Global Head of Infrastructure and Energy Finance at NATIXIS. I would like to thank you, Nathalie, Marc, Jeetu, for joining us today. It's a great honor to have you with us. I think it's a very timely discussion, and we very much look forward to getting your views from debt, equity, and M&A perspective on how the infra market is behaving and will behave in the future in this so particular context. So with that in mind, I will ask you just to introduce maybe yourself and what you're doing at your respective companies.
Okay, thanks for having me. My name is Nathalie Kosciusko-Morizet. I'm a senior partner at Antin. I'm leading the efforts for a fund called Next Gen Fund. It's early stage infrastructure investing, so it's greener, more connected assets than you would find in the classic Antin funds. And prior to that, I was a politician in France.
Hi, everyone. Good afternoon. Also, thank you very much for having us here. My name is Jeetu Balchandani. I head up the infrastructure debt group at BlackRock. We manage about 21 billion in investor commitments in infrastructure debt across the credit spectrum, investment grade all the way to mezz across all the major infrastructure sectors, including including mostly developed markets and some emerging markets as well. I think that's.
Thank you, Jeetu. So my name is Marc Vincent. I've been running the CIB of NATIXIS. This is the reason why I'm speaking the last. For almost 8 years, I believe. I'm now in charge of global M&A. It's a network of 7 boutiques that we control and which are operating on a worldwide basis.
And I'm Nasir Khan. I'm the head of infrastructure and energy finance for NATIXIS in the Americas. So rarely have we seen a confluence of macroeconomic challenges of the scale that we see today, all occurring at the same time. And Jean-Francois went through some of this in his remarks earlier today. So first off, inflation, 9% across the US and Europe, really levels that many people in this room have never witnessed before. Then we have supply chain challenges, driven largely by COVID lockdowns in China and what actually started the inflationary spiral in the first place. Then in response to these inflationary pressures, you have central banks raising interest rates, which has the very obvious impact of raising financing costs. But what does it do to valuations, equity returns, project feasibility? With the higher interest rates, that in turn has increased the threat of recession, which is then going to lead to a slowdown in demand. You know, what impacts is that going to have? And then overarching all of this, we have the war in Ukraine. And that has led to a dramatic increase in energy costs, not only in the cost of gas, but also in the cost of electricity, where gas operates on the margin. So what does all of this mean for the infrastructure space? Infrastructure has long been touted as an asset class that is resilient across business cycles and offers inflation protection. Is this true, false, or is the answer more nuanced than that? Well, we have an esteemed panel here that is going to answer all of these questions and solve all of the world's problems in the next 45 minutes.
Thank you, Nasir. So maybe first question for you, Nathalie. So prior to the current environment with the rising rates, we saw equity returns constantly being under pressure. So basic question, in this new context, are equity returns also increasing? What are the other key impacts on your investment strategy and on your exit strategy?
I love your basic questions. What are the non-basic ones, just so that we know? So let's solve the world's problem together. Well, in the current macro environment, we do expect markets to get tougher for all of us. However, would also think that in this environment, infrastructure is the place to be. And this has been evidenced in the past. If you look at what happened during the global financial crisis, infrastructure asset class showed a great resiliency. Very few assets went belly up. Markets remained open, both for equity and debt. And we expect the same to happen here. And there are reasons for that. Key characteristic of infrastructure investment is stability of cash flow, hedging inflation. This is, by the way, two key characteristics of the anti-infrastructure test. And we, if I think inflation hedging, we do the same when it comes to debt. Acquisition debt in infrastructure tends to be nearly 75% hedged, which I think is very different in the PE world, so we're sort of protected. So in this context, we do not plan to change our return targets. If you think about it, at Antin, the return targets have been constant since inception, and that was in 2008. And by that time, interest rates were over 4% in Europe. So it's just stable over time, whichever the situation. And there are foundational reasons for that, because we do 2/3 of our IRR with EBITDA growth, and only 1/3 with repositioning of the business and working on the capital structure. Leverage is obviously one piece, part of the toolkit, but it's not the main lever. Hence the conclusion.
So Marc, you see transactions across a wide range of sectors, including infrastructure. And do you see investors in the infrastructure space behave differently than other investors? And have you seen any impacts on activity in the M&A space?
I would start by stating the obvious. An investor in infra, in an infra asset, is not an investor in private equity. This is obvious. This is the reason why, over the last 15 years, many investors have been focusing on the infra, pure infra assets. Just a quick example about what has happened over the last few months, and we can see that very well. The private equity market has been hit by what we can call a market disruption. The closing of the high yield market has been obviously affecting that market and reducing the number of transactions. We have not seen the equivalent in the infra world. So this is an obvious example. Now, if I want to be a little bit more granular, when we look at the core and super core segment of infra, frankly, because of the regulatory nature of those activities, because they are monopoly or quasi-monopoly, we see still a strong interest in those assets in the market. So there has not been any slowdown in that segment, probably because we can anticipate better the return on capital invested. There is more protection, as Nathalie was saying, against inflation, commodity prices, and all the rest. Now, maybe in the current environment, with the pressure on purchasing power, we can see in some cases regulators or governments trying to reduce a little bit the pass-through of inflation to the consumers for obvious reasons. So that may put a little bit of pressure on the returns that we can see in that sector. But frankly, we continue to see great interest. It is really the playground of big investors, asset managers, big funds, ready for that sector to write a very big equity check. So again, I have not seen in any market so far a significant reduction on that. Now, concerning value-add infrastructure, maybe a little bit closer to private equity, still a lot of activity in some sectors where there is clearly a need. You know, I would mention education, low emission mobility. Those kind of sectors are still driving a huge amount of interest. So I would say globally, over the last months, we have not seen a significant slowdown. And again, as Nathalie was saying, we feel that those assets are still looked at very carefully by a number of investors.
Thank you, Marc. Jeetu, same question for you on the debt side. Have you seen a change in appetite from debt investors or changes in financing structures in response to these macroeconomic challenges?
Yeah, so firstly, sort of wholeheartedly agree with Nathalie and Marc on the points they're making. From the debt perspective, we're starting to see a little bit of a shift, right? When you kind of think about the way transactions were underwritten as little as 3 to 4 months ago compared to today, we're facing a much more uncertain future in terms of interest rates, inflation, impacts of energy prices and the like. So when we think about what types of transactions we would be willing to underwrite today, we have to kind of think about different sets of assumptions that we're going to use, anticipating that it's going to be a much more challenging period for the next 3 months, 6 months, year, 2 years, who knows, right? So when you factor into those, in some of those assumptions into your analysis, you do need to look at the sensitivities of what happens to refinancing risk, what happens to inflation, what happens to your debt service coverage ratios. So I'd say that's starting to happen, and it's pretty real time, right? So if you have a fully contracted asset, which has got inflation protection and fully amortizing, well, that's kind of in one easier camp. If you're looking at financing a corporate infrastructure where there's bullet amortizations, there's refi risk, there's potential inflationary impacts, that becomes a little bit tougher, not impossible, of course, but you need to start to take into account all those considerations. So I think there's always a way to find a good solution in ensuring that you're designing your debt to match the asset and the business. And I think the creative lenders out there will always find a way.
So looks like the risk perception is not changing much from any perspective, actually. In terms of pricings and cost, and I think this is the million-dollar question, what we've seen recently in the bank market is that pricing have just slightly increased, I think mostly as a result of the increased cost of funding of banks, not as a result of a different risk perception. So Jeetu, where do you see the pricings going forward for the infra projects? Do you see any imbalance between bank and institutional debt? Do you see any imbalance, or well, you see some imbalance between public and private debt? So how long can this last?
Well, as we've seen from history, the private markets generally take anywhere from 3 to 6 months to catch up to the public markets. So we've seen a good amount of volatility in the public markets, and I think the private markets are starting to adjust. So that's the good news from the private side. At the same time, the public markets have started to moderate. So as relative value investors, I think most institutional investors on the private side will look at what's going on the public side as well as kind of what's going on in the bank market as well. And that's been, I think, one of the key challenges that we've faced at the beginning part of the year, because the bank costs had not caught up to what the public markets were saying. That's starting to change, and as you mentioned, bank costs funding costs have gone up a bit. So it's a little bit more of a level playing field today. But looking into the future, I think we're still going to face a fairly choppy market for at least the balance of the year, from what I can tell. And how that factors into transactions on a day-to-day basis is going to be really a developing situation, right? I think there were times where you could commit to certain terms and conditions and hold those terms and conditions for a very long period of time. I think it's a bit more challenging in today's market.
It's true that today's market is probably a bit different from yesterday's market. So very blunt question again for you, how long can you hold a pricing today?
I thought you said no hard questions.
That's an easy one. Come on.
Yeah. Let me go back to kind of what was in the normal market, right? It was fairly normal to hold pricing for 90 days even, right? Spread. and in certain cases longer than that also, those P3 bids which required you to hold pricing, and the market generally accepted that, those lenders that were part of that market. So from that standpoint, the world has definitely changed, right? And that's not happening today. And what is happening today, I think it's on the order of weeks, maybe a month, that I think lenders are willing to hold pricing. Every situation, again, is going to be different, and probably next week is going to be different from this week. But I think that's currently the context, because just take the last week and the kind of volatility we've had in the last week. The U.S. capital markets, to a large extent, are shut to a lot of borrowers. So when you're facing those kind of conditions, and investors, on the other hand, that are looking at what their current balance sheet and book looks like, and some of the volatility they've seen on the public side, the private side can offer some solace, particularly going into potentially a slowdown or a recession. But at the end of the day, it also has to make sense to take on that additional private paper.
So Marc, and by the way, this question could also be to you, Nathalie and Jeetu. Is it a good time in this context to buy and to sell infrastructure assets? So that this is the question for you as in your current position. Also, as a former head of CIB at NATIXIS, do you think it's still a good time to lend to infrastructure, to the infrastructure sector?
Good question. Many people are looking at me to see whether or not I'm going to change my mind on that. But look, concerning buying, selling infrastructure assets, frankly, there is a lot of liquidity in the market still. There has been less capital raising recently, but clearly, there is a lot of dry powder. When I'm traveling worldwide, there is incredible amount of projects to be financed in every country. I was in Italy last week. The number of infra projects which are in the mind of a number of decision makers in Italy is just huge. So I would say it is still a good time to buy and sell. Maybe I have just one remark that maybe, in your investment teams in this room, you have maybe people who have not been in front of this current environment, the way it is today, in the past 10 years. They are young, they have not seen a different market. It is a new paradigm, and I think it is going to take a little bit of time to adapt to this new paradigm. It is completely different. Now, to be back to your question on CIB, what can I tell you? I'm going to do a little bit of advertising for NATIXIS, obviously. I just cannot do else. But we have been investing in the infra world for the last 10 to 15 years to become probably, I've seen your slide, a go-to bank in infra. Where I am very pleased is that we can do that on a worldwide basis today. We can do deals in Latin America. We can do deals. We have been doing deals with your company, 3 deals in Australia very recently over the last few months in infra. We can do deals in North America, in Europe. This is just something which is very important for our clients. We have been developing something that you all know in this room, which is what we have been calling the originate to distribute model. Maybe I have been too much involved in that process, but frankly, this is just an incredible success. We have been in a position to talk at a very senior level with asset managers, insurance companies worldwide to provide them with our expertise, with our analysis of assets. I consider in the current environment, it is still an excellent asset class. We need to, I'm no longer the head of the CIB, but this is my best advice. Continue in investing, in reinforcing your expertise and your ability to do deals. And for the clients which are in this room, don't hesitate to solicit NATIXIS on any M&A project in infra, obviously.
Thank you, Marc. Truer words have never been spoken.
Maybe something to say on that.
Yeah. Well, the next question is for you, Nathalie, and you can certainly add on to what Marc had to say. But as a next-gen investor, you focus on what some may consider less traditional areas of infrastructure and those which carry at least a higher perception of risk. How do you see it? Do you see that to be the case, or do you actually see the current environment as an opportunity?
No, this is only perception. Listen, I truly believe we are, the type of assets we invest into are not riskier. It's a different risk profile, for sure, but it doesn't mean that overall it's a higher risk. And let me explain maybe. I do early stage infrastructure, so there is more greenfield risk, there is more scale-up risk, for sure. However, there is not the risk of being stranded. There is not a risk of being disrupted because we invest into the disruptors. There is no regulatory risk because all the regulatory changes are on the upside side of my business cases, considering the type of assets we invest into. So overall, I would say it all nets out. And I would note also that we don't take technology risk. We invest into assets that are technology proven, need capital to scale up and develop at commercial scale, but are technology proven. There is a recent evidence to that. This is the Inflation Reduction Act in the US. You know, this recent bill that President Biden just passed. It's like $370-something billion invested into the sector. It's amazing, obviously. It's not only amazing in terms of amount, it's amazing for me in terms of runway. It's committing to 10 years for a certain type of a production tax credit, investment tax credit. For example, for hydrogen, you get $3 a kilo for the next 10 years. And you have bonuses on the top of that. Well, you can at least. So this is an evidence that regulatory changes are on the good side for the type of investment we are looking at. And there are foundational reasons to that state of fact, which is that we ride long-term trends. And this is the answer to the answer I would have given to the other question too, which is that cycles come and go, but we need to look beyond the cycles to try to identify long-term trends that won't come and go. Certain are obvious. I mentioned earlier that I would like to invest into greener, more connected infrastructure. Some of those are more subtle. I would mention maybe 3 of them. And I'm giving you here my secret sauce. Proximity, flexibility, and autonomy are 3 trends that we see deep and strong into our sectors. I would note that these have only been accelerated by the recent events. Would it be the pandemic or the war in Ukraine? And I think riding these, we can't screw up. Would that be good English to say we can't screw up? Maybe not. Well, you got it.
I'll add that we talk about the 3 Ds, decarbonization, deglobalization, and digitalization. So very, very similar trends. But I'll also add, Marc, to your comments earlier. Yeah, I do believe there's going to be a little bit of a bid-ask gap, and maybe not just a little bit, maybe a wide bid-ask gap in terms of kind of the buying and selling of assets and also the financing of assets. One can't help but think that what was the case as little as 3-4 months ago, we're in a different world today in terms of how much leverage could be provided to the same project, what cost it's going to be provided at, and facing those assumptions, maybe there'll be transactions that are on the margin not as economic as they were before, or there just might be a gap between what a seller expects and what a buyer wants to pay. So I don't know if that kind of gets solved eventually. It should get, but with a new normal, but it's really uncertain as to how long that'll take.
Yeah, so Jeetu, next question for you is, and Nathalie touched on this briefly, referring to Biden's plan, also known as the Inflation Reduction Act. So, with all of the macroeconomic challenges that we are facing, we are going to need some help from governments. And the Inflation Reduction Act is a step in that direction. So what do you see the impacts of that are going to be? So what are the principal elements of the Inflation Reduction Act, and what sort of impacts do you think it is going to have on the infrastructure sector?
Yeah, absolutely. Well, Nathalie kind of hit the nail on the head there. I think it's about 370 billion of spend in the IRA, and the largest amount is towards the renewal of the renewable energy tax credits. So that's the investment tax credit, the production tax credits towards wind, solar, hydro, geothermal. And on top of that, there's additional tax credits granted for extension of tax credits for carbon capture, for hydrogen, as Nathalie mentioned. There's air pollution mitigation manufacturing tax credits as well. And there's some interesting and really critical changes to how those tax credits can be monetized as well. There's a direct pay option. There's a potential to transfer the tax credit one time to another entity, and that cash payment is not taxable, not deductible, but not taxable either. So I think all in all, that really should help deployment of capital in those sectors. And importantly, this is a long window. Construction needs to start on certain transactions before January 1st, 2025. So that gives developers a 2.5-year runway. In certain other sectors, it's a 10-year runway. So I think all of that will help. There are challenges also, and some of the challenges are going to be transmission, pipelines, supply chain. So it's not without any challenges, but we do believe that there's going to be a significant deployment in those specific sectors that is going to help U.S. infrastructure be more competitive. And kind of the name inflation reduction is really trying to reduce is deficit reduction, but it's also cost reduction for the consumer and businesses in the U.S.
Yeah, so you mentioned the tax equity provisions, and that has been somewhat unique about the U.S. market. The way it has facilitated investment in renewables has been through tax credits as opposed to feed-in tariffs and other sort of mechanisms we've seen in other parts of the world. So the fact that there is now transferability of tax credits available under the Inflation Reduction Act, do you see that as having an impact on perhaps reducing the stranglehold of private tax equity investors and opening up tax equity to a broader group?
Yes, for sure. And having spent a lot of time on the tax equity side in my previous life, I can definitely say that there's really been a handful of tax equity players out there that all developers need to kind of get to in order to monetize those credits appropriately. And no matter what's happening with the interest rate environment, as we've seen, we've been in a very low interest rate environment. Tax equity returns have not changed very much. So opening that up and allowing more participants into that market will definitely have. Now, the counter to that is there should be a lot more projects that are coming to market also. So, but in the end, you wouldn't have had that deployment if you didn't open up that market.
Another question for you, Marc. We've been talking a lot for many years about energy transition. Today we are talking about energy security, and the previous panel discussed about it. So be keen to get your views on whether or not the need for energy security can impact the need for energy transition.
Look, I'm going to be fairly quick on this one. What I feel is that we are in an environment where energy security is probably a priority because of the environment, because of the war, because of everything. This is short-term view. The long-term view is that energy transition will continue. There is no question. It is a long-term trend. It is not going to be reversed, in my mind. We will not come back. That's for sure. That is my conviction. And by the way, when I'm looking at the price of renewable energy assets in the current environment, I think I'm not wrong in my assessment. So again, I think maybe short-term, we need to think about energy security for obvious reasons, but the long-term trend is, in my mind, absolutely obvious on energy transition.
Thank you, Marc. Nathalie, so Antin is a transatlantic firm that has expanded rapidly in North America. You are yourself based in New York, leading the next-gen investment efforts for North America. Would you say that the dynamics that we have been discussing in this panel are different between North America and Europe? Do you believe that geographies are diverging or converging when it comes to those trends that we have previously highlighted?
Sure. I would say that the trends, and the one we mentioned earlier, are definitely the same. And as I said, have only been accelerating lately. And you can see that in our investment portfolios. For example, we did Origis. This is a large solar developer in the States with Fund 4. And just recently, the opening investment in Fund 5 is Blue Elephant. This is renewables development in continental Europe, and definitely doing the same with the Fund Next Gen. We are riding the electrification trend in both Europe with EV charging and smart grids and North America. So the trends are the same. However, I recognize that the stage of development of subsectors are not similar, and this creates opportunity for a transatlantic fund like us, opportunity to leverage the expertise on one side of the Atlantic to help better understand and foresee, if I may, what's going to happen on the other side. And by the way, it goes both ways. It's not a one-way street. There are certain subsectors that are more advanced here and certain subsectors that are more advanced there. For example, if you look at recycling, anything recycling related tends to be more advanced in Europe. And we definitely leverage this experience. Wastewater, especially, anaerobic digestion, much more advanced in Europe. Currently looking at anaerobic digestion plays with RNG on the top. In the States, probably we not consider this next gen in Europe, but definitely do in the States. Hydrogen is more advanced in Europe. However, United States might catch up very quickly with Inflation Reduction Act. But if you look at carbon capture and usage for a variety of reasons, good and bad, in my perspective. But anyway, a reason is a reason. It's much more advanced in the States. And there are interesting things to play there. One last thing I would note, by the way, is that we are discussing here, sort of global vision. Very interesting thing to work out in the United States is the difference between states. Some of them are obviously much more advanced than others. Can always think of California, but if you look at carbon capture, for example, there's an interesting local law in New York State that is going to be implemented, I think, 2004. L97, that's the name of the law, local law, LL, and it says that for any building above a certain square footage, you will have to pay, I think, $268 a ton of CO2, beginning this date, for any ton you emit. So you badly need to find a solution, including, carbon capture solution, because you have your gas-heated boilers and you need to do something. So it's not only a question of global dynamics, there are also very interesting local dynamics to be looked at.
So I was wrong. I said that the panel was going to solve the world's problems in 45 minutes. They have done it in 40. But we have time for questions from the audience.
I think we can give a great applause to everyone.
Thank you. Apparently no questions. Well, I think you're definitely hired to save the world. And we'll think about NATIXIS, obviously, for merger and acquisitions.
Count on you, obviously.
Thank you very much. A great applause to you. Thank you.